I'm sure people have heard us say this over and over, right?
But if you see it, you will believe it. If you give it enough time, the compounding, when it starts to hit, it really grows quick.
You're listening to The Road to Financial Independence by CPS Investment Advisors, where smart planning and sound strategy keep you steady as you grow.
And welcome back to another edition of The Road to Financial Independence. I'm Mike Riskin, president of CPS Investment Advisors. And as always, I'm joined by my partner and CEO of CPS, Peter Golotko. Hey, Pete.
Hey, Mike, how you doing?
Terrific. Another beautiful day here in sunny Florida.
Another beautiful day. What are we talking about today?
In this episode, we're going to really dig down into, hopefully help our listeners with some of the terminology and also maybe some of the math and let them visualize how this stuff really works, because people say, well, if I give you $1 million in the stock market, it doesn't just magically grow to 2 million, does it?
No, it doesn't. It doesn't. And how long will it take to grow to 2 million?
Right.
Yep.
And there's a lot of different factors in there.
There is.
And what are the cool concepts that we help our clients visualize it with is this rule of 72.
It's a math equation.
Yeah.
And I love math. That's probably one of the only things I can do well.
That's
math.
Right.
But it is a math equation. And the rule of 72s, if you do the math equation, it'll tell you how long at a certain rate of return it'll take your money to double.
Okay.
So to give an example, if you got a 6% rate of return, how long would it take your money to double? So if you did the math.
You always start with 72.
Right, and you divide it by the rate of return.
divide it by the rate of return. So 72 divided by 6, you get 12 years. So
12 years.
If you averaged, and obviously the stock market, you're not going to get 6% every single year.
No, it's got to be
an average.
Right, it's got to be over the 12 years.
A 12-year window.
Correct.
If you did 6%, if you started with $1 million in 12 years, you would expect it to be $2 million.
Yep.
If you averaged 6%.
That's correct. And the reason why you want to look at this is, people want to get to a certain point in their lives where they're financially independent,
right,
where they have enough money to replace their income where they go to work. Okay. So, if you're talking to a client and you tell them, hey, you want to make $150,000 a year with taxes, you need $3 million, 5% withdrawal
right.
rate.
And we've talked about the 5% withdrawal rate.
And if you're starting at $1 million, how long is it going to take you to get to $3 million?
There you go.
And what rate of return do you need to get there? Okay. And let's say, they got $1 million and they want to work another 20 years. How long, and they need $3 million. How long will it take them to get there? And
right,
can they get there in 20 years?
That's right.
So you do the math, and if they've got $1 million, and let's say they do real well in the market and they want to do a 10% return.
Okay.
So that means their money's going to double in 7.2 years.
Right.
So
it's fairly quickly.
Very quickly.
Yeah.
Usually we say 10 years, right, and that's,
it's about a 7%.
A 7% return is, doubles in 10 years. So, the next part is now you doubled it. How long is it going to take you to get to 3 million?
That's right.
So now it's not doubling your money. You've got 2 million now. Down to get 3 million, it's going to be a lot quicker.
Right. And so not all 7% rate of returns are created equal.
They're not. Absolutely not.
Because that first doubling
off
the million gets you to 2 million, but you still earn that same 7% rate of return. So basically you don't necessarily need to add or reduce any risk in your portfolio.
No.
And
you're going to make it.
And you're going to make it a lot quicker.
You're going to make it real quick.
Because of the compounding.
Yep.
Yep.
And so you just have to give it time. And what people fail to do is give it time.
And time is, Mike, I'm sure people have heard us say this over and over, right?
But if you see it, you will believe it.
That's right.
If you give it enough time, the compounding, when it starts to hit, it really grows quick.
Right. And I know in some of our previous podcasts, we've mentioned that a lot of times people start investing the money, and in the first few years, if say the rate of return doesn't always differentiate itself enough until you get to that 7-10 plus year window.
Just don't lose the money.
Don't take it out.
Don't put too much risk in there,
right,
and don't take it out, because the problem is if you take it out, it's too hard to save that money. And if you know that once you start saving, it's going to take you 10 years to get to a critical mass where compounding now makes sense, don't lose the money. Put it somewhere. Close your eyes for the next 10 years. Just keep saving and putting it away. Keep saving, and close your eyes. And before you know it, you're going to be a very wealthy person.
Right.
Yeah, if you can do that.
Yeah. The longer you wait, because of the compounding effect, the either the more money you need to put in to get to the same result, or the increased rate of return you'll need, which of course there's no free lunch.
There's no free lunch. No,
you're gonna have to take on some risk. You probably don't want to.
That's correct. And if you start early and save often, you don't have to take a lot of risk.
Right.
Your portfolio should do well without rolling the dice.
And that's the success. And then, some people might be starting a little later in life than they want to. Maybe they, for whatever the reason, they're later, or maybe 40s, 50s, haven't really saved anything yet. I think the key there is don't feel like, have a plan. We always say have a plan. Come in, talk to somebody, and do the math. You might actually be surprised at how the math looks in terms of getting to where you need. And also, it's a reality check too.
It is.
Of, hey, this is what retirement might look like.
But also, if you're 50 and you hadn't really saved, like you felt like you saved enough, it doesn't mean that you can't start.
That's right.
Because 10 years at a 6.5% return or 7% return will double your money. Mm-hmm. Okay. You don't have to hit home runs. Maybe get a 10% return. Maybe do some, a little bit extra risk. Do a 10% return. Now you're at 7.2, and then it doubles again quickly after that.
Yeah.
So it's not you don't have to be frustrated and stop saving altogether because you're not there. Save as much as you can because it'll help in the long run.
It'll always help. Yeah.
And if you're 50 and say, well, I'm gonna retire at 65. That's 15 years. It doesn't mean you're cashing out and going to cash and spending all your money at that point. Your investment horizon actuarially is to 94 years old. Right. So the money's going to continue to grow for you. Right. Just put it away, and allow it to start compounding for you.
Yep. And we'll get into another concept in a little bit, inflation and how that factors into all of this.
Well, we felt that recently.
We used to talk about inflation, and we'll get into it a little bit, but we used to talk about inflation, and people were like, yeah, whatever. But
3%. It's always been around. Oh, wait, maybe 4%, 3%.
No, now people take us a little more serious.
Well, that's taxation without representation. They pulled money right out of your pocket without any representation.
Yep.
So we'll talk about that.
Exactly. And back to just saving as much as you can when you can. Mm-hmm. One of my favorite things I hear you always say is no one's ever complained to you about making them save too much money.
Right. Nobody said, hey, Pete, I'm so mad. You made me save too much money. Right. And now I've got so much money that I don't know what to do with. Nobody's ever said that. Right. But they did. I've heard people say, I've not saved enough money to bridge the gap. We're going to have to work longer.
Right. To live the way you want to on your timeline.
Correct. Or if they stop working, they take an instant pay cut.
Yeah.
And that's very painful, too, for a lot of people.
Yeah. Cool. Well, and continuing with sort of the education piece here, some of the feedback we've gotten some of our listeners has been that they love the podcast, love the two of us. Sometimes we'll say some terms or whatnot.
We talk in Greek.
We do talk in Greek sometimes,
yep.
And we try not to. But
we like this stuff. That's what we do, and not everybody does what we do.
That's right. That's right. You don't get the shiny head for nothing. Right?
No, your hair doesn't fall out for nothing.
So let's just go through some terms that we've even discussed on the show today. Let's start with compound interest. What kind of help our folks explain what that is?
Compound interest is when your interest makes interest. Your money makes money. Okay, and I like to give the example of, you got $1,000 and you made 10% on that $1,000. Now you got $1,010, right? Correct?
I'm sorry, you have $1,100.
$1,100. I try to cheat you out of a couple of bucks. You got $1,100.
I'm keeping a close eye.
Well, next year you don't have $1,000. You got $1,100, making 10%. That's
right. So you made 110 instead of 100.
That's correct. And you add that to the pile. Now all of a sudden you got more money earning 10%. Right. You got more money earning. That's how compounding works. And before you know it, you get to $100,000 and 10% of $100,000. That's a lot of money. That's right. And you throw that on the pile, and now you're making. You got to get to that critical mass where the returns make a difference. Right. If you have $1,000, it doesn't matter if you make 10% or 5%. It's not going to make much difference. You got to keep saving. You got to build that pile and don't lose it.
Yeah. One of the best visuals I love when we talk about compound interest is a snowball. How, the snowball starts out pretty small, but as it's rolling down the hill, it just gets exponentially
bigger. Yeah, it doesn't take long before it's a big snowball.
So for me, that's a great visual.
Yep. You got to have a lot of surface area to make. You got to have a lot of stocks, a lot of investments to make that earnings continue.
Right.
So a lot of surface area for a snowball, a lot of surface area for your investments. Keep growing that, and more money will be coming out every year.
Exactly. So let's talk about rate of return. What are we talking about when we mention rate of return?
That's the percentage of increase in your investments over a certain period of time. A lot of people say, okay, rate of return, we'll do rate of return over an annual basis, January to December. And the rate of return is what the increase in your account is divided by the beginning balance.
Okay.
And that gives you the rate of return for the entire year.
So if you started the year with $1,000 and at the end of the year it was $1,100, then your rate of return was 10%.
10%. It's the $100 divided by the.
And so that's how much the market appreciated.
Correct.
On average. Now,
Correct.
what if with the style? So there's two ways to make money in the market.
Oh yeah, absolutely.
So you might, let's say you started with 1,000, and the price of the stocks went up 10%, but maybe you also collected a 2 or 3% dividend.
Yeah. Maybe
so
now
actually
income
came into your account
13.
So closer to 12 or 13%
right.
total return.
Total return.
Yeah.
So you do have that, and that helps with the income coming in. Also helps because not only you're putting money in, you got the income, the stock's growing, and then you got the dividends. Right. So let's say your stock grows, and you take those dividends, you invest those dividends, you buy a little bit more stock. Guess what happens next quarter? You get more dividends. Yeah, because you have more stock.
That's right.
And every year, if you buy great companies, they raise their dividend every year, regardless of how the economy's doing. Because the companies are doing well, that means that you get an instant pay increase. You don't even have to go to your boss and ask for it. It just comes to the mailbox.
Right.
And you take that money and you buy more, and guess what? More money comes in next quarter.
Right.
And that's how people build wealth.
That's how people build wealth. No, perfect. Let's talk about inflation. What exactly? I guess just describe the term there, and we'll get into some of the numbers on inflation in a minute.
Inflation, I call inflation a tax. Okay, inflation is the growth of the cost of goods over the years, and usually, historically, the U.S. has had a 2-3% inflation rate,
right.
and all of our math in the past has been 2 to 3% inflation rate. There have been some periods of time where we've had incredible inflation, where it's grown quite a bit, and you can go back to the 1980s.
Incredible in a bad way.
In a bad way.
Yeah.
Now, high inflation number is not good for Americans at all, because it deteriorates your buying power. That means that when you go out and buy a bar of soap, and that soap was $1, we had 25% inflation. That bar of soap went from $1 to $1.25. So all of our goods continued to go up, and we had pretty much a 25% increase in all of our goods. Now, why did that happen? Why does inflation happen? And inflation is directly related to energy. Okay, you can look at every chart, and every chart, energy prices pull us into inflation, and energy prices pull us out of inflation. Right. And if you're going to think, are we going to have some inflation? Just look at the cost of fuel, cost of gasoline. Yeah. If it's $4 to $5 a gallon, we're going to have some inflation, because energy touches every piece of what we do, from our eyeglasses to these microphones, to putting in our car, to farming our food, to delivering our food to the stores, to turning the lights on in the stores. Everything, every piece of manufacturing has a big energy cost to it. And when that energy cost doubles, guess what happens to the cost of our goods?
Pretty much everything goes up.
Everything goes up. Yeah. Correct.
And also, you got to look at the increase, not to get too in the weeds, but also the increase in the money supply. Yep. If when we talk about those periods where there were stimulus,
correct,
and a lot of money was going back out to the consumer,
you got more dollars chasing the same amount of products.
Correct. So
which
people
means
are willing to pay more
absolutely.
for it. Naturally,
we saw in 2020 where during COVID, where a lot of places were shut down, but people still got their paychecks. Right. So guess what happened to the toys, the boats and the RVs and the ATVs? You couldn't find any because everybody's buying those. Yeah. And when there's more money going after goods, prices go up. Yeah. And they're not coming back. if prices went up, inflation goes up for a short period of time and comes back down, wages don't have to be adjusted.
Right.
But when it's a long period of time, the reason why inflation doesn't come down, or prices aren't coming down like people thought they should, is because everybody had to have their wages increased just to live. Those wages aren't coming back down, so that's a fixed
That's
cost.
when inflation becomes sticky.
That is very sticky, and that's where it's going to stay.
Right.
So, don't expect your goods to go back to pre-2020 prices. They're not. They're going to stay where they are. And whenever we have bad inflation, that's the pain that we have to go through. Is the prices aren't going to come back.
Except the Costco hot dog seems to be staying at
It's
a
staying there.
$1.50.
Yeah, but I'm sure. Well, you got the Dollar General that's now what, the $1.25.
Right.
Dollar store's now
That's right.
$1.25
That's right.
store. So even the dollar store got hit with increased costs.
And our producer Will was telling me that even the singer 50 Cent now calls himself 25 cent.
Yeah. Oh yeah,
It's
that's right.
crazy,
Only
yeah.
25 cents.
That's right. So let's talk about diversification. We talk about that a lot as well. What are we talking about when we talk about diversification?
So investing your money in markets, in investments, is risky because any investment, regardless of what it is, could have problems, could lose value, could go out of business. We really don't know the future for everything. Now we can have some very good guesses because we've got 100 years, 150 years worth of data. And we know which companies do well and where people spend their money. But diversification is spreading your risk amongst a lot of different asset classes. Okay. So let's say, for instance, you worked for XYZ company, and in your 401k you have XYZ company, and since you wanted to save money and you believed in the company, you bought XYZ stock. You're not diversified. You are a one stockholder.
Right. If something happens to XYZ, you're in a lot of
if
trouble.
XYZ goes from $100 to $50, you lost half of your wealth.
Right.
Like that. So to avoid stuff like that is you want to spread that amongst XYZ, ABC, and NND, all these other great companies, and I'm making these up.
That's right.
Just to stay out of trouble.
We're just throwing,
acronyms out. But if you buy great companies, you spread them across. You can properly diversify with 25 to 30 different equities in 10 to 12 different sectors.
Right.
Pick the right sectors. Sectors that, regardless of what economy we're in, people still have to spend money there. So if you do that, you can properly diversify your portfolio. But there's also something out there called diversification. Okay?
What is that?
That is when you buy so many things that you have very little investment in any one piece.
Okay.
And if they go up 10%,
So you
it
actually
makes
don't get
no
any of the
difference. You get
upside either,
no
yeah.
upside. It's just you spread it out way too far.
Right.
Okay. So diversification, you got to do it properly. You don't want to get too much where, your good investments, if they grow, you're not going to feel it.
Right. You want to definitely mitigate the downside, but you need to participate in the upside.
Absolutely.
Yeah. All right.
Absolutely.
And talk about principle. That's one that used to. When I first heard the term principal back when I was middle school or high school, that one always got me. But
yeah, that's the guy who smacked
that's
your
right. That's
fingers.
what I
If you got in trouble.
Right.
That was way back when I went to Catholic school. That's what happened to me. No, principal is the money that you put into the investment.
Okay.
What you start out with or what you add to. That is your principal. And a lot of people say, when I retire, I don't want to touch my principal. Okay. Well, that's a great goal. Don't touch my principal. The principal is what they put in. They want to spend the earnings. They want to spend the house's money.
Right.
Okay.
Right. And
they don't want to spend
dividends, the interest,
Correct.
the rate of return. Yeah.
Yep. And a lot of times, if you do the math, you're going to have to spend a little bit of principal. That's part of it. That's part of the the withdrawal rate that we come up with. But as long as the portfolio is growing at a reasonable rate, taking a little bit of principal isn't going to hurt you.
Exactly. And we already talked a little bit about volatility, the ups and downs in the market, and
in the short term and also long term. There's long term volatility, and there's volatility in stock price. There's also interest rate volatility, where interest rates, if they go up, you might have problems with the bonds you own.
Right.
If they go down, you might have problems. So there's volatility across any asset class. A lot of people say, well, if I go out and buy a REIT, it's just going to, real estate's going to go up 3 to 4%, and I'm going to do well. We're going to sell it. But when you look at volatility right there with a REIT, you've got interest rate risk, has a lot of volatility. We saw when interest rate went up, a lot of your real estate, holdings went bankrupt. Interest rates could go down, and you're locked into a high interest rate where you're missing out on opportunities to have money to reinvest. So there's risk across the board, and there's volatility. And if you have a lot of risk, and during volatility, you'll see your portfolios go up big swings.
Right.
You don't want
This is
that.
why you want to stay diversified.
That's correct. That's correct. So if one stock goes down, maybe the other 24 go up.
Right.
And you really don't feel it.
So to sum it up, the principle, you put the money in, you want to diversify.
Correct.
Diversification, because of volatility in the market, might go up and down. You need to participate on some level in the rate of return, which is what you get in terms of how much the portfolio grows, to help hedge against inflation, which is the rising cost of goods.
Correct.
And all of that, your rate of return over time is how compound interest is calculated.
Correct.
And hence we go back to the rule of 72.
The rule of 72s. But I want to caution everybody that you want to be an owner, not a loaner. Okay?
An owner, not a loaner.
An owner, not a loaner. Okay. A loaner is you go and loan the bank money and you buy one of their CDs, and they pay you an interest rate for the next 3 years. You get that interest rate, and then you get your money back. You loaned them that money for them to go out and make more money.
Right.
All right? What I want you to concentrate on is being an owner. Going out and buying a share in a great U.S. company that pays a big dividend, that is in a sector that makes sense, that you have to spend your money there. That's owning a company. And what you do is you participate in the income. It may not be as much income as you get on a annual basis on a CD. It may be a little less. But here's the thing. That income goes, if it's the right company, it goes up every year.
Right.
You buy more of it, they give you more income, and that CD, which is a stock, grows in value.
Right.
So you're knocking out on both ends. Having your investments in CDs, fixed income, bonds, they don't keep up with inflation. Okay,
right. Not all the time, and they're appropriate in certain circumstances.
They are, and we do, and you want to have fixed income in your portfolio, but you don't want to rely on that to be where your growth is.
That's not for your
be.
long-term growth,
correct?
Right, and I think that's what we're focused on here.
And that goes back to volatility. You've got to take some risk. Right. Stocks are maybe a little bit more volatile than bonds. I mean, you take a look at it; they're going to grow a lot more. You want to make sure that you do have some risk in there, and you're going to have a little bit of understand. There's going to be a little bit of volatility.
That's right. All right. Well, we'll appreciate that. So we talked about the Rule 72, went over some of the terms, kind of the investment philosophy there. So let's go to my new favorite segment here, the rapid fire question and answer. Here, kind of myth versus math segment, if you will. This will be fun.
Oh,
Can't wait to hear your answers on these.
I'll give you an honest.
This is why our listenership keeps going up, because I ask the questions and we don't know what Pete's going to say.
No, what's going to come out of my mouth.
The viewership is just off the charts. So first myth, Pete, I'll double my money faster if I time the market. I mean, that sounds like
a great idea.
Sounds like a great idea.
Yeah, I mean, if you know when the market's going to go down and then when the market's going to go back up, you can make a lot of money. The problem is, and the reason why we're still in business is that's impossible, because markets are weird.
They act irrational.
They act very irrational. Yeah. So, give you an example. A company comes out, they beat analysts' expectations. They say the next quarter is going to be good also, and they go down 5% that day.
Right. And I get clients that ask me that all the time. Why did the stock go down? I thought they just reported great earnings. And I said,
we want to know too.
That's right. And but if anything, So we'll buy some more of it.
And you could probably make some money if you know a company's in trouble and you know the stock's going to be down for a while. But that's not really how you make money. You make money in buying great companies that go up. And the data shows if you were to time the market and sell out and try to get back in, you underperform fixed income.
Yeah.
Because it's too hard to pick it twice.
You got to be right twice every single time.
Every single time.
Yeah.
Now, the math is, and we can go back to 2008. If you were invested in January 1st of 2008, you saw your portfolio go down a minimum of 40%. Okay? So Your $1 million is now $600,000. And the market at the bottom of the 2009 at 2009 at the bottom, the market hit 6,500 on the Dow. Where's it right now?
We've crossed over 50 a couple times.
Oh, yeah. So it's 50,000 right
50,
now.
50,000, right?
So if you were to just close your eyes for 14 months and not look at your portfolio, you would be a very wealthy person right now. But what happened during that period of time with people that really didn't understand what they owned, they sold out because everybody's telling you this is new. Nothing's going to come back.
Right.
Well, it wasn't new. We saw the same thing happen
Right.
in the 80s with real estate that we saw in 2008. It wasn't new. We came back, everything was fine, and people are making money. But you can't time the market. It's just too difficult.
Right.
And if somebody can figure that out, it'd put us all out of business.
Yeah.
Fortunately, the market is driven by emotions a lot of the time.
Yeah.
And I'm not really in tune to a lot of people's emotions. I can read the data, and I love the numbers and the math, but then emotions hits, like, I don't get that.
Yeah, and the other problem, a lot of times people try to time the market based on information that they're reading online, and really the news is about 95% negative. And so if the market's down, there's going to be really bad news, and you're definitely not going to want to buy,
Right.
even though you should. And when the markets are up, all the news is just going to be about why it's about to go down.
Yeah.
And
You're
so you're
it
never
scares
going to
you.
get back in.
Right. So, our philosophy is, and the data proves it, buy great companies, close your eyes, and when the market goes down, hey,
Buy
get
some
some other cash. You got dividends coming in. Use that as dry powder to buy some more of these companies on sale, because when it does recover, and it will recover, you have more shares recovering.
Yep.
And more dividends coming in, which is beautiful. And during down markets, a lot of people don't realize this, your great companies that pay a dividend, they don't lower their dividend. You still get the same amount of money regardless of what the price of the stock is. And the next year, even if the stock's down, they're going to raise the dividend. They always do.
Right.
So, you're still going to get the same income stream.
Yeah. Nope, that's great. That's a great point. All right, second myth here. 6% really isn't that much.
It isn't.
That doesn't sound like much.
I mean, it's not a bad return.
I don't think so. But
People try to beat it, but you think about it, 6%, your money's going to double in 12 years. And what have I been telling people this whole time? Investing in the market is a marathon, not a sprint.
Yeah.
Okay? A 6% return will not keep you from sleeping at night. You're going to sleep very well at night because you're not going to have a lot of volatility in your portfolio. In 12 years, it's going to double.
Right.
And it's going to double
And
quicker
then it's
after
gonna
that.
double, yep.
So a 6% return isn't a bad return.
Right.
Now, if you can get 10, great.
That's right.
If you can sleep well at night at 10, great. But a lot of people can't do that.
Right.
And if your financial plan dictates a 6% return, why do you want to add more
That's right.
risk to your
That's
portfolio?
and that's the whole point, is really preparing, saving early, doing the right things. You won't. That's part of the point here, is that you won't have to take on unnecessary risk.
Correct.
Yep.
Correct.
All right. And then last quick fire myth here: inflation doesn't matter if I'm earning interest.
During 2020 through 2024, you turn on the TV and they talk about inflation like it wasn't a big deal. And a lot of people didn't realize it, but inflation compounds.
Yeah, it does.
Okay. So let's say, we have a 7% inflation this year, which is horrible. Next year, we have a 7% inflation. In 2 years, inflation went up 14. Your cost of goods went up 14%.
Right.
It is devastating to your finances, to people's finances. It's devastating to businesses because their costs are going up because of inflation, and then they've got to raise wages so that people can continue to live. Inflation is horrible.
Right.
And if we can, inflation's going to be historically around 2 to 3%. If everything is moving correctly, we got to stop doing these things that cause inflation to jump periodically.
Yeah. So
It doesn't have to happen.
Yeah, because if you're earning, you want to be safe, and you have all your money, say, in something that's earning 3% or less, but
And
the inflation
inflation's
rate's
3.5.
higher than that, you're losing money.
You're losing money. You're losing your buying power
You're losing your buying power.
because that your portfolio, the money you have, can buy less goods.
Right. And the rule of 72 applies to the inflation
Absolutely.
effect just as much as your rate of return.
You're absolutely correct. You know, how long does it take for inflation to double?
Right.
Well, when you're looking at a 25% increase in inflation in 4 years, that's pretty bad.
That's pretty bad. Yeah, that's pretty bad. All right, awesome. Well, Pete, I appreciate covered a lot today, and kind of some of the basics, so to speak. But I think really bringing it back to some of the terminology, hopefully help people visualize what they're really seeing when they invest money and how it works. And when they're working with an advisor, kind of some of the terminology out there and how advisors are seeing how to invest their portfolio as well.
And there's really no get-rich-quick scheme out there.
Thank you. I'm glad
legal.
you said that. Yeah.
It takes a long time. So buckle in. The more you save, the quicker you're going to get there. But buckle in and just keep going at it. A lot of people, things happen, they get discouraged, they stop saving. Don't do that.
Yeah.
You'll be extremely happy that you bit the bullet, tightened your belt a little bit, and continue to save.
Yeah. And to your point, if it sounds too good to be true,
It is.
it is, and otherwise everyone would be doing it.
Everybody would be doing it. Yep, absolutely.
All right.
And if somebody wants to sell you something that's the greatest thing since sliced bread, take a look at how it's doing for them in their portfolio. I bet you they don't own it.
Right. Fair point. All right. Well, thanks, Pete. Appreciate the conversation.
All right, have a good one, Mike.
Well, thanks again for joining us for another episode of The Road to Financial Independence. If you like this content, don't forget you can find us on Spotify, Amazon, or now Apple Podcast. And don't forget to like, comment, and subscribe.
The information provided in this podcast is for informational and educational purposes only and should not be construed as investment, legal, or tax advice. CPS Investment Advisors is a registered investment advisor with the U.S. Securities and Exchange Commission. Registration does not imply any level of skill or training. The opinions expressed on this podcast are those of the host and guests and do not necessarily reflect the views of CPS Investment Advisors. The information discussed is believed to be accurate at the time of recording, but may not remain current. Listeners should not consider the discussion or any information shared as a solicitation or recommendation to buy or sell any particular security or investment strategy. All investments involve risk, including the possible loss of principal. Past performance is not indicative of future results. Before making any investment decisions, listeners should consult with a qualified professional about their individual circumstances. For additional information about CPS Investment Advisors, including our services and fees, please review our Form ADV, which is available at www.advisorinfo.sec.gov.